have a superstar opening panel, which I'm very proud of, and they will have a full 45 minutes to discuss the future of private investing. So with no further ado, I would like to welcome Zade Zalatimo, who will be moderating, who's the Managing Director for the Private Funds Group at Houlihan Lokey, and his excellent rockstar panel. Please welcome them to the stage.
Good morning. I was expecting a bit more of a turnout, but I guess it's still very early. Well, thank you all for coming. I'm honored to be moderating this panel. This panel needs no introduction, but allow me to introduce them anyway. To my left is David Rubenstein, who many of you maybe have seen on television. He hosts a show called Peer-to-Peer Conversations. Of course, he's the founder of the Carlyle Group and has recently released a book, which he has joined us from his book tour. Next to him is Ammar Khudairy, who is chairman of Samba and was very busy up late last night doing something which I'm sure he'll tell us about shortly. Erik Kaas from the Partners Group. He's chairman of Europe and is responsible for strategic relationships in this region and Europe and comes here very often. And Hartley, who is chairman of Hamilton Lane, which is the largest allocator to private equity, credit, and private investments in the world. Thank you very much. So the panel is entitled The Future of Private Investing. But I thought we would start off talking about something in the public markets, which I'm sure you are all very interested in learning about, which is the Aramco IPO. Ammar, you led that IPO. Congratulations.
Thank you. Thank you.
So many of you probably have seen teams of Western bankers in Riyadh Airport marketing their services to underwrite Aramco, but none of them were involved in the underwriting. You led that process.
Well, they were involved in the underwriting, but at the end of the day, there was a last-minute call to make it a local IPO, so there was no proactive marketing outside of the region. And so the book ended up being covered, by and large, entirely locally, by local banks.
By local banks. And how did the book build work? How did it look?
Well, we can tell you what the allocation, the final allocation looked like. Fortunately, the book was oversubscribed 5-6 times to 1, and so the issuer had the luxury of crafting quite a well-balanced book between very long-term holders, a little bit of traders. So we designed a book that will allow a good liquidity, but at the same time, a large pool of stable shareholders. And we were able to do that because of the oversubscription. So just to give you a rough idea, the final allocation, 23% of it went to non-Saudi entities, 37% went to institutional investors in Saudi Arabia, 26% went to funds, things like long-only funds and index trackers, and 13% went to GREs.
And internationally, was there an allocation as well?
Yes, sir. 23% was international.
Okay, well.
Yeah. But a lot of it is Gulf and also some American and European and Chinese money.
And you start trading in an hour?
We start trading in an hour.
Okay, well, good luck. We'll all be keen to see how that goes. David, you were one of the first private equity investors in Asia. You made a lot of money in China, and you've spent a lot of time going out there. I was wondering if you could give us a historical context to the current US-China trade war. And I thought I would actually read 2 quotes from Donald Trump, and maybe you can help us understand them. The first one is, quote, "They have systematically sucked the blood out of America. They have gotten away with murder. We have to tax the hell out of them." The second quote is China devalues its currency and is sucking the blood out of the United States. They have gotten away with murder. Not anymore, folks. Now, the first quote was actually Donald Trump in 1989, and he was referring to Japan on a talk show. And the second quote was on his 2015 inaugural campaign rally. So I'm wondering, what are the parallels between what is happening now between the United States and China and what happened in the 80s between the United States and Japan?
Well, in the 1970s and 80s, and I worked in the White House in the late 1970s, there was a general view in the United States and among other people in the world that Japan was going to be the largest economy in the world. It was then the second largest, now the third largest, and that Japan was using certain trade rules to their benefit, and the United States was not responding appropriately. That was the view in the United States. As it turned out, Japan did not turn out to be as strong an economy in the 1990s and in this century as people had thought. And Japan's still a large economy, but it hasn't had quite the global impact that China now seems to have. China, remember, Japan is a country of 120 million people. China is a country of 1.3 or 4 billion people. It's much more complicated. And they have national security ambitions that might be much different than what Japan had. There's no doubt that Japan is still an important economic presence in the world, but not at the level of China. The trade deal that President Trump is now in the process of negotiating, which I suspect I believe will be announced sometime soon. They've reached a phase 1 agreement, and I think they will reveal it, will, I think, have some impact that'll be favorable. But you have to remember that throughout the history of the last 1,000 or 2,000 years, it's never the case that the two largest economies in the world get along swimmingly and they just cooperate on everything. There's always a rivalry. So right now, the United States is the largest economy in the world as measured by GDP. China is the largest economy in the world as measured by purchase price parity. And these two economies, to some extent, have clashed on certain things. The biggest issues are not really going to be in the phase 1 agreement. The biggest issues are the technology changes that China wants to make in its technology and how it'd like to be a leader in the world in 5G, in semiconductor production and design, artificial intelligence. In the United States, in things that didn't get in the agreement, would like to, I'd say, not have that be quite as robust as the Chinese would like it to be. Time will tell. Right now, unless things are resolved in some way that I can't foresee, you'll probably have a Chinese set of technologies around the world, an American set of technologies around the world, and countries will have to pick who they want, the Chinese technology or the American technology. It's hard to have both. And right now, that issue isn't going to be resolved. I think the China trade agreement will likely be politically helpful to the president. It's not going to solve all the problems, but it will be somewhat better in terms of delaying any clash between China and the United States. And it will, I think, keep the United States economy in reasonable shape and prevent any recession that might have occurred if this trade war went on.
Okay, I know, Hartley, you reference what's going on in China in your writings, and your firm has a view. What do you think is sort of going to happen in the foreseeable future in relation to private investors going into China, particularly from the United States?
I think it's kind of in a temporary lull right now, somewhat because of the things that we've been talking about. So the flows have been a little slower this year and last year. I think it will absolutely come back. I think when you have the opportunity for an economy of that size that's growing the way that economy is growing, 6-7% a year, the opportunities for private investing are huge, and you have the infrastructure there now to allow for private equity to function well. You have a large number of high-quality general partners who've built good businesses, they have good process, they have good track records, they know how to manage things. So I think over time it represents a great opportunity. I think we're in a little bit of a lull right now. Of course, they also have to continue to address where companies are getting liquid. The Chinese stock markets are still a bit volatile and a bit of a mystery. And so as those continue to develop, I think it will help our industry as well. I think it'll be great opportunities.
Erik, you have offices in Asia as well and are very active in China. What are you seeing from your perspective?
Yeah, so I mean, what you clearly see from the client side is China is a little bit the dream that never happened. You know, I think a lot of people were very enthusiastic, and people, I think, on average, probably got disappointed about the returns they achieved. But I think it comes back to what Hartley was saying, is certain government structures were not there. Probably the money didn't quite arrive where it should have arrived at the time. But I think this has professionalized a bit. So I think it just takes a while for people to get used to it again, that there are actually good GPs opportunities. We learned our lesson. No, we would never ever take a minority stake ever in our life again. We definitely only take majority stakes. So you just have to protect yourself against some of the governance issues. But obviously, it's a great big economy. A lot of things like child toys, pet things, like the trend of everywhere. Just you can do that as well in the big retail markets. Of course, it's an important market, and repositioning retail stores. It's quite an interesting market still. Yeah.
It's still the largest growth market in the world, right? China, for most private investors, and will probably continue to be for...
But I think just hesitation has been there, no? I think now we hear a lot AI, so I think for AI, obviously, it's a technology market. It's quite a good target, I guess. But I think just people got burned a bit, and that will just take a while for the big pension funds, I guess, to come back bigger style, I think.
Ammar, from your perspective, I think China is China the largest trade partner for Saudi Arabia? I know for the UAE, China is the biggest trading partner.
Yes. Yeah, it is for Saudi Arabia. It's one of the top 2-3 relationships globally, for sure.
And are the Chinese investing in Saudi Arabia? I know they're investing in...
Not yet.
Okay.
I mean, they are doing this. They've tried to crack the code, but they haven't cracked it very well because there's a business model that they're used to in Africa or in the Indian subcontinent. It doesn't apply to Saudi somehow.
Okay.
I'd say when China first opened for private equity investment, non-Chinese firms tended to dominate certainly the larger deals because they had greater expertise, and the Chinese were relatively welcoming. Now, as the Chinese have recognized the skill set that the private equity people have, they have, in effect, duplicated it or maybe improved it in some cases. And so now the larger deals tend to have large Chinese partners leading them, and the Western firms are not quite as dominant or influential. They are still involved, but not quite as dominant or influential. And the slowing growth of China has made it more difficult to get the kind of returns that people got 10 years ago or so, but it's still a very attractive market because it's so large.
Okay. I was wondering if we could talk a little bit about the current cycle we're in. So the past 5 years have been unprecedented success for private markets. During that period, more money has been raised, invested, and distributed to investors than any period in history. There's a recent Bain study which says, quote, private investment seems to be on a secular penetration curve that has no end in sight. And I'm just wondering, are these the kind of brazen statements that maybe signal that an end is in fact maybe in sight?
I can help us. Yeah, is a lot of money coming to industry? Yes. No, we all spoke in this conference already. Are valuations high? Yes, they are high. No, and large cap, 12 to 16 times for companies, partly even more. Yes, it's high. But I think it's also, if you look at relatively, equities also went up. So relative to equities, actually, it's not that crazy. Returns on debt is low. So in this environment, I think it's going to continue quite a bit. But then I think what you have to do then in the private markets is to position yourself just in case things don't go so as well as they might have done the last few years. So I guess you have to price in, if you buy a business today, price in a decline in the multiple when you sell it in 5, 7, 8 years. And there are definitely certain trends underneath you have to position yourself in, which I think people also can only buy in the private market, not in the public market, is certain trends that are disruptive. And if you look at healthy food, I mean, the food industry grows very little in the world. But if you look at healthy food, it grows dramatically. I'm the board of a company. We doubled our sales and EBITDA in the last 3 years in catering and restaurants, whereas the industry itself didn't grow at all. You know, I see this with pets. Humanization of animals. Now we bought a big chain in America because old people aging. You have people they humanize the animals, spend a lot of money, and I think it's a fact that in the financial crisis last time, people spent no money on the new trousers for their kids, but they would buy still their doggy, their fifi, the nicest food and the biggest toys. So there are trends you can buy in private markets, which you probably cannot buy in the public markets. And I would also think at some stage, and probably David has some views on this. I think you will also see the biggest deals ever happening where people take certain companies private out of the public market. And I think this has to do with the governance advantage of private equity over public markets. Now, I would call it government correctness. One problem we find in the, at least we observe is because of some problems that had in the financial crisis, boards tend to be in public markets very risk driven. You know, people just tick the boxes, make sure how the accounts are correct, etc., but not very risk taking, making sure that the business actually grows. No, in Switzerland we have this problem as well. Certain boards should not have any members on the board that have anything to do with the company. Well, then good luck controlling the company if you don't know what the company does. No, but it's just certain regulation has helped, and in private equity just don't have that. Now the board is fully working for it, has even projects to do in the business. If you have 5-year views, they have stakes in the company. So it's this trend I see continuing. Will there be some problems in between? Absolutely, we will bugger up some deals in our industry, but as a trend, I would see it's continuing.
And Hartley?
I think anytime you've had an asset class that's had the kind of run that private equity's had, it's natural to ask the question of how long can it go on. I think there are some kind of myths and some realities about the asset class that I think are important for people to understand. One of them is that the fundraising has actually been flat over the last couple of years. This year's total private equity fundraising will be about the same as last year's. Deal volumes are actually up a little bit, so the dry powder amount is going down a little bit based on all the data that we have. So the number of years of dry powder sitting there today is somewhat less than 3, which is a little bit below the historical average because the deal activity in private equity remains very, very strong. So I think it's a little bit of a myth that things are very extreme. It is true that prices are high. It is true that leverage is high. It is also true that interest rates are very low, and that the kinds of debt terms that private equity investors can get today are very, very attractive in terms of being able to give them a lot of flexibility if things go wrong in the companies that they're buying. I think one of the best things that happened to our industry was the global financial crisis, because the same people, David and others like him, that were running the firms back then, by and large, are still running the firms today, or the people that have been trained by them. And that taught them a level of discipline that is very different than it was in 2007 or 2008. If you look at what happened in terms of distribution activity and selling back then, in terms of prices being paid, in terms of leverage being put on, and in terms of new funds being raised, and the upsizes from one fund to another, in the global financial crisis, it was much more extreme in the run-up to that than where we are today. GPs, by and large, are acting in a much more disciplined way. They're being much more disciplined with their clients' money. And so, yes, I don't think trees can grow to the sky, but I think this tree has a way to go.
And also talking about discipline, sorry, just one statistic we noticed in our deals we look at, there were at least 100 auctions we looked at that failed. So it's not like every business that's being offered is bought there. So there's certain discipline on what type of business you buy, which probably also led to a certain premium for certain deals people are looking at to buy. Oh, sorry, Dave, do you want to say something?
I was just saying that for the last 25 years, people have been saying there's too much money in private equity, and for the last 25 years, generally people have been wrong. Now, clearly, when the economy goes down, private equity returns will probably come down, and it won't be as robust as they would otherwise be. Private equity cannot repeal the laws of the business cycle. But generally, the general partners don't feel that they have to invest this dry powder because there's no penalty. You don't go to jail if you don't invest the money. You just give it back if you can't find good deals. And remember, you have preferred returns and other considerations that make it difficult to want to put money out just to put it out. So generally, I think the private equity firms are pretty disciplined, as you suggested. But it's also important to note that in private equity, the returns expectations of investors have come down. So if the return expectations were 20% net internal rate of return, as they might have been 25 years ago, it would be difficult to get the money out, and maybe there would be too much money. But investors are willing to accept much lower rates of return, and therefore, relative to the rates of return that can be achieved, I don't think there's too much money there. Investors today would say, give me 13%, 14%, 15% net internal rate of return, and those returns are achievable even at the slightly higher prices that we're paying, even though they're seem robust. They're not that high relative to public markets.
Okay, I just want to switch back to our region, Ammar. It's been a tale of two cities. In the West, private equity is seeing it's another golden era. All the references to dry powder and capital raise, whereas in our region, we haven't done so well. to date, I don't know of any large GPs that are raising a MENA fund. There have been many very well-known departures from our industry, without naming any of them, a couple of scandals. And you established a private equity firm that actually produced some really successful exits. In fact, I think maybe the largest exit in the history of the region.
Possibly, yes.
Possibly, 10x,
Yes,
yeah.
yes.
So what's happening? I mean, what do you think will get people to come back and think about our region as a place to invest private equity?
Well, so let me just give a statistic to reinforce your point. In 2008, before the crisis hit our shores, there were 92, 93 announced PE firms and PE funds. As of today, I think we have maybe 6. And I might be exaggerating when I say 6. So you're right, there's been a capitulation, falling off of a cliff. And there are a few reasons for that. I think the one fundamental reason, if we were to isolate, if we wanted to name the primary reason, is this. If we look at Saudi, which is the biggest market in the region, in the past 5 years, the Saudi market has been break-even. The MENA region has had a total returns over the past 5 years of 4%. And as David would know way better than me, private equity works on outperforming markets because it is part of the economy. You cannot be economy neutral. Whatever the economy does, you try to outperform it. And so when your capital market does 0% in 5 years, even if you're a superstar and you overachieve your market by, say, 5, 7, 8%, okay? Private equity lives, the fuel that feeds the private equity fire is the 2 plus 20. And if the 20 disappears completely from the equation, there's not much left in the game. And that's what has happened over the past 6, 7 years. There's just no 20 because the capital markets, which is an indication of what's happening in the economy in general, has been flat or below flat. Going forward, I think a couple of things will happen. 3 things. Number one, I think the economies of the region will start recovering, and so we will see capital markets doing better, which means private equity will start making some money again. Number two, we will see a bit of a bifurcation of private investing. So it won't be as much private equity, but I think we'll see much more VC, which we begin to see now already, with a couple of very healthy, high-profile exits. And the amount of money pouring into VC now is becoming quite high. And the other one that we'll see is private infrastructure, because Saudi has been talking about privatization, both greenfield and brownfield, for 3 years. Not much has happened. Last year, we piloted a few projects, the government did, and this year there's a very aggressive plan. I was with His Excellency, the Minister of Finance, day before yesterday, and the country is privatizing 21 water-related assets. They're privatizing a few thousand schools. All of that's happening in 2020. And so we will see private investing coming in, but at the low end of, at the VC and at the private assets.
I mean, in the MENA region, the way I looked at it, we had a fund here, and we are not operating it now, though we have some residual investments. You have 4 parts of the region. You have the Levant area, but because of the wars and other things, they are not an attractive place to invest. You have Northern Africa, but because of the uncertainties there, the Arab Spring, the uncertainties in those countries, among other problems, hasn't been an attractive place to invest. Turkey has been a reasonable economy, but it really doesn't need people with MENA skills. You really just, people who know Turkey can do Turkey, and there are some good Turkish funds. So the only area where there's really activity that you probably would want to focus on would be the Gulf area. And the Gulf, there are 2 principal challenges. One, you have to have things to be purchased in order to make investments, and very rarely do people want to sell things in this region. There just aren't that many things. Many family-owned companies are going to be in families for quite some time, and they don't see any great incentive to sell. There just aren't that many government-owned properties that are being sold. There are some, perhaps, in Saudi now, but generally there aren't that many things to buy. Another problem has been that what many people would like to see in the region at the MENA funds is have Western capital come into the region. But the truth is, most Western capital, United States, Western Europe, and let's say Asia as well, they don't really see the MENA as an attractive area for private equity investing. So the money that is invested here largely is already money that's already here. It's other MENA money that's being invested through some other vehicle. So it's not as attractive in a market as it has been in other parts of the world. It could take off, but it's going to be a while before you're going to see large numbers of private equity firms coming here, in my view.
I guess, Hartley, you don't have a lot of endowments and institutions from the West looking to allocate to this region much?
No, I think David said it very well. I mean, I think that you have to look at where the big economies are and what's going on with those economies. And so Turkey was a place that actually people were really interested in. And just as we're not immune from the business cycle, we're also not immune from geopolitics. And so what's happened in Turkey with the currency and the economy there has created some damage in private equity portfolios that were exposed to MENA. So there's, in the short term, there's some working through, particularly I think with those deals. I think in the longer term, though, people look at One Belt, One Road. They look at the access into the stands from this part of the world. They look at the trade flows that are going on from this part of the world. And I think they will increasingly wrap that together in a bucket with this area together with India, Southeast Asia, and that kind of One Belt, One Road area. I think the infrastructure opportunities are very significant, and people, as was said before, people are increasingly focused on those.
The economies in the MENA region, particularly the Gulf GCC countries, they're relatively modest-sized economies compared to some of the Western economies when you take out the oil and gas factors, because that's what really propels those economies. And since those oil and gas-related parts of the economies are not really available for private equity investment by and large, if you take a look at the other parts of the economy, there's not that much available for sale. The economies aren't that big, with the exception of Saudi Arabia. Now, Saudi is very large, even if you take out some of the oil and gas factors, and there will be more attractive opportunities there. And I do think that people that hang around the hoop there and are ready to invest in Saudi will get some benefits. I don't think you'll see a lot of Western money going into Saudi Arabia at the current time. I do think there'll be a lot of Saudi money that will reinvest in private equity in Saudi.
Just wanted to change gears a little bit and talk about a growing area in private equity, which is GP stakes. So there's a firm that not a lot of people associate with private equity called Neuberger Berman, who have a strategy called Dial, and they just raised a $9 billion fund. They have $23 billion under management, focused on investing in GPs. Is there going to be a lot of growth in this area, and do you see other opportunities for people to provide financing to GPs?
Let me explain for those who aren't obsessed with private equity what's been going on. As a general rule of thumb, when you build in a business, you would like to get some economic reward for it, and one of the ways you do it is you sell what you built, or sell some part of it. The larger private equity firms are big enough so that their founders were able to monetize some of what they built by going public. But if you're not large enough to go public because there's just not a large enough market capitalization, or you just don't want to be a public company, if you're a founder and you want to monetize some of what you have achieved, you will sell a stake to somebody else. Now, Dial has come along and dominated the business of buying stakes of up to 25% or so. People, and these are generally stakes that the founders can sell, get some monetization. Time will tell whether the rates of return will be as heroic as the investors in those funds would like, but generally Dial does their deals on the assumption that they don't have to sell the stake to another party, just the cash flow off of the stake, let's say it's 25% in a given fund, will be sufficient to get the returns of, let's say, mid to high teens. Time will tell whether that's true, but the investors are pretty happy with these things already because more and more money is getting put into this area. So it's a growth area, and I think the greatest growth area in the future will probably be new funds that are coming in where people will buy GP stakes in new funds as opposed to some of the existing funds. But right now, the bloom is not off the rose, and I think people do think it's a pretty attractive area, and it's a way for people to monetize and get a reasonable return on what they've invested in terms of building an organization.
Speaking of new funds, Erik, Hartley, do you invest in first-time funds?
Oh, yeah.
Yeah, but anyway, we do much more direct. So 70% of our business anyway buying not funds, but doing direct investments. But on the fund side, we have done. I think generally speaking, we would prefer then that the teams have worked somewhat together. So a pure first-time fund where people have not worked together, I would personally be more hesitant. Some other people have different strategies probably, but no, preferably not. But if they have worked them together, have a good strategy, and you are seeding them on the real estate side, yes, definitely. But on the private equity side, I would just be a bit hesitant.
In the industry, portfolio construction really matters. I mean, private equity has grown now to where it's of a size that it's a very meaningful part of people's portfolios, whether it's a pension fund, endowment, sovereign wealth fund. And as such, you need to be able to do portfolio construction the way you would with bonds or with stocks. And smaller funds, newer funds, play a very important role in that portfolio construction. So while you have your big, stable, proven platforms, the Carlyles, the Blackstones of the world, there's a different risk-return profile that comes from the newer funds, the spin-outs and things like that. So we like to say we do plenty of first-time funds, we just don't do first-time managers. In other words, the people we're backing are people who've done it before, who have a proven track record, networks, know how they're going to manage this. Because the opportunities that they're going to find, the size range that they're going to operate in often are areas where you have faster growing companies and where you have the ability for the GP more easily to add value to those companies. So it's definitely got an important part in the portfolio construction in private equity.
See, the theory behind investing with large organizations like Carlyle, Blackstone, Apollo, KKR, and so forth is that the rate of return will not vary that much. They're relatively predictable. They're very well-established practices, good professionals and so forth. They're going to see very good deals. And so the disparity between the bottom and the top is not going to be that great with those funds. You kind of know what you're getting. With first funds, people don't know what you're going to get because sometimes the first funds are people who come together, they don't really work together well, and they break up. But if you are fortunate enough in getting first funds that do work out, you probably can get a very good rate of return because these first funds tend to be small, and therefore the people tend to be younger, hungrier, and they're trying to prove themselves. I think at Carlyle we've had 450 funds over the years, and perhaps one of our best was our very first fund when we only had $100 million and we were younger and maybe we worked harder, I'm not sure. So I do think that if you invest in first funds and you know what you're doing, you can find some spectacular rates of return, but you've got to be much more careful because some first funds will not work.
Your first Asia fund was
it was spectacular
success. One of the largest exits in the history of China.
So, I personally invest in first funds, and I like to buy stakes. In my family, obviously, invest in GP stakes and buy first funds because I think you're going to get some very hungry people who are going to work very hard and probably work harder than the people who were 20 years older, and maybe because they have a smaller amount of money, the internal rate of return might actually be higher.
Your daughter's in the audience. I think she has a first-time fund. I guess maybe people.
Well, that's the best first fund anybody could put their money in, of course. But
that's right. I think she'll be on a panel later on. There's another trend that certainly is emerging and has become very popular in private equity, and that is long-duration funds. I think we are now in the second vintage of long-duration funds. Carlyle has one, Apollo, many others. Have these funds actually delivered returns that they promised, and do we see more firms moving into long-duration funds? Presumably this is an area that is of great interest to sovereign wealth funds and people who are really not that interested in exits earlier.
Yeah, I mean, I think it's been very much a phenomenon in the last few years. I think they've been harder to raise, I think, than some of the people who have launched them thought they would be. They were sort of launched a little bit with the Warren Buffett strategy in mind. If I'm going to find a very high quality asset and own it for a very long period of time, and that's a great thing for investors who want to be owned in that way. I think it also goes hand in hand with the expansion of retail access into private equity. Because there is more and more evergreen vehicles, there's more and more access for smaller investors. The SEC is, of course, many people know, changing the rules to allow lower levels of investor to participate in private equity under some of the exemptive clauses in the regulations. And for those kinds of vehicles, for evergreen type vehicles, longer dated investments can be important. And so investing in funds that have the longer horizons can work. The debate is typically, is private equity an agent of change, or is private equity an agent of long-term stable ownership? And I think as the industry has grown and matured and proven that it is a really viable alternative to public ownership for companies for longer periods of time, that these kinds of funds are going to prove themselves and will succeed.
Yeah, I think also what's important is I think the return expectation on a long-term fund is just lower than on a traditional private equity fund. Huh? So people will, but there's businesses out there you can buy that just deliver you a little bit less return, but in a much more secure manner. No, we also used to own a business in America. That was the #1 outsourcing for insurance back office, and was a cash cow. But at some stage, the target returns didn't hit our fund target anymore, so we had to sell it. But I would have loved to keep this company longer, but just with a lower return target. So I think, yes, there are certain businesses out there as well, but particularly when I think what's going to happen at some stage if private equity takes more public businesses private, that some of these businesses are just very stable businesses. You can grow them a bit, but just will not hit the traditional private market target, but a totally great business you can hold for a very long time, so you make it money over time. So this area is growing because also people don't want cash back and then they need to invest somewhere else again. But I think coming to the returns, I think it's just too early to tell, in my opinion, because these funds are still quite recent. No, the ones you mentioned, it's not like they have been around for a long time already. So, but I'm sure they will deliver, but just slightly less return. It's totally perfect. They will have lower hurdles. Some of them have already lower hurdles, different fee structures.
I think the long-dated funds can work for investors who do not really want to be making investment decisions every 4 or 5 years on redeploying capital. So if you can get some people that know what they're doing, they can hold on to investments for 5 to 10 years or even longer, get you a 12, 13, 14% IRR over that period of time without having to redeploy the cash and make a new investment decision. They have work, but there are a limited number of these funds because you really need to be a sovereign wealth fund or a large pool of capital to go into these funds because only they really don't want to make the decisions every 3, 4, 5, 6 years on deploying large sums of capital.
We only have a few minutes left, and I thought maybe we'd talk about something that probably everyone's thinking about. What will happen to private equity with a President Bernie Sanders?
I think the problem there would be less the private equity than other issues. I would say, in my view, I think he is likely to be elected president. I don't see any polls that say he's likely to be elected president. I think the biggest issue is what Congress is likely to do, or somebody who's likely to be president to do with private equity. And I see right now private equity has its detractors from time to time, but as a general rule of thumb, people recognize that private equity is not Darth Vader. It actually does very good things for the economy, and I don't see the opposition to it in the mainstream of American public thought right now. There are people on the fringes who do, want to change private equity, and I'm not saying it's perfect, and there can always be improvements, but as a general rule of thumb, I don't see major regulatory or legislative changes in the private equity industry we know in Western Europe or United States in the near future.
Yeah, I'd say I completely agree. I mean, still today, the biggest investment pool investing in private equity worldwide is U.S. defined benefit pension funds. And those U.S. defined benefit pension funds are by and large public pension funds, because most corporations have gone to defined contribution funds that in the U.S. cannot invest in private equity today. And so those funds are helping teachers, firefighters, policemen, sanitation workers, and other government employees to enjoy a good retirement. Those funds have a big funding challenge in the U.S. today because they've been underfunded by the governments, typically, that have set them up. And so they rely on private equity and the returns generated by private equity to increase and enhance their funding levels. I think it's incumbent on the industry to get the word out about this, to continue to talk about it, and continue to demonstrate the benefit that's accrued specifically to states and other taxing authorities by having had investments in private equity, because it's literally saving the taxpayers of any state you could name billions of dollars in unfunded pension liabilities if they didn't have private equity today. So I think David's completely right. I think people recognize that, but we need to make sure we continue to get the word out given the amount of noise that comes at the industry from the left-wing press.
I think people also recognize if you invest a lot of money in private equity, you're likely to get to heaven more quickly. And that's a big advantage of private equity. It's something that God favors, and God looks favorably upon people that invest a lot in private equity.
That's why I'm in private equity.
I agree. That's the most important thing is you're going to get to heaven if you invest a lot in private equity. There's no doubt about it.
Okay, well, I hope we've converted some people here. Thank you very much for your time. We are out of time and look forward to seeing you all very soon. Thank you very much.
Thank you.